The stock market just hit all-time highs again. But what if I told you this might be the most misunderstood rally of the year? AI is booming, inflation is falling, and everyone's chasing the next big stock. But under the surface, the signs aren't all green. So, should you buy the breakout or brace for a blindside? Stick around because by the end of this video you'll know exactly where the market's heading, what to avoid, and which stocks could power your portfolio this July. Big picture. What just happened in the markets? Welcome back to Elite Growth Maps, your ultimate blueprint to mastering wealth, finance, and self-development. In this channel, we turn complex markets into clear opportunities. Let's dive into what just happened in global markets this week. The S&P 500 rose 0.83%, and the Nasdaq added 1.02%, both hitting record highs. Leading the charge, tech stocks. Nvidia, the poster child of AI, gained another 1.3%. Even the Dow Jones moved up 0.77%, approaching its own record. Globally, the MSCI World Index gained 0.65%, while Europe lagged slightly with the STOXX 600 up just 0.47%. So, why the rally? Because the US economy added 147,000 new jobs in June, beating expectations by over 30%. That's strong. But here's the twist, this data is too good for the Fed. The Fed, rates, and why it matters to your wallet. Unemployment ticked down to 4.1%, which sounds great, until you realize that strong jobs data equals less chance of a rate cut. In fact, the odds of a July rate cut dropped from 24% to under 5%, practically off the table. As a result, the 10-year Treasury yield jumped to 4.35%, a rise of 5.3 basis points. The US dollar strengthened across the board, gaining 0.38% on the week. The yen fell 0.95%, and the euro slipped 0.37%. Here's what this really means. Borrowing costs stay high for longer. That pressures real estate, small businesses, and riskier investments. But it also means the Fed thinks inflation is cooling without crashing growth. The elusive soft landing. Inflation, oil, and the hidden opportunities. Let's talk inflation, the quiet hero of this week. Core PCE inflation, the Fed's favorite metric, fell to 1.77% annualized, slipping below the 2% target. Oil prices dropped too. Brent crude fell 0.46% to $68.79, thanks to easing Middle East tensions and weaker global demand. Lower inflation plus lower oil equals more breathing room for consumers and businesses, and this sets the stage for the real winners. The big plays where smart money is moving AI and tech infrastructure are the stars of this cycle. Dell is crushing it with AI servers. They've streamlined operations and analysts see double-digit EPS growth and up to 48% upside. Amazon, AMZN, is expanding Prime Day to 4 days and remains largely tariff-resilient, protecting margins. Trade Desk, TTD, is rebounding in the ad tech space, and its new AI platform, Kokai, is expected to boost earnings ahead of the 2026 World Cup. On the defensive side, Edison International, EIX, stands out. Why? It offers a 6.5% dividend, is benefiting from AI-driven energy demand, and is recovering from wildfire-related losses. It has a 51% upside potential and consistent earnings growth. South State Bank, SSB, just made a major acquisition in Texas. Expect 23.6% EPS growth and steady dividend income. And don't overlook international markets. Coforge in India is expanding fast in AI and cloud, with a per $1.5 billion order book and per $2 billion revenue target by 2027. The MSCI Emerging Markets Index is up 12% YTD, fueled by lower valuations and government stimulus. Major risks to watch right now, but not everything is sunshine and rallies. Smart investors are watching these critical warning signs. 1. Tariff tensions. Yes, the US just signed a new deal with Vietnam, but broader trade friction could raise costs and squeeze margins later this year. 2. Speculative excess. Some low-profit tech stocks are up 30% in Q2, despite weak fundamentals. A growth slowdown could pull the rug out from under them. 3. Labor market cracks. While jobs were added overall, private sector hiring has softened. Long-term unemployment is rising, which historically signals a recession 6-12 months out. So, this market may look bulletproof, but there are stress points forming under the surface. Elite Growth Strategy, July 2025. Playbook. Here's your elite growth map for July 2025. Short-term strategy. Focus on AI-driven tech like Dell and consumer giants like Amazon. Stay defensive with utilities like Edison International, stable, tariff-proof, and tied to AI power demand. Long-term strategy position into emerging markets, especially India's renewable energy sector. Inox Wind is one to watch. European industrials are also gaining steam, especially with their lower PE ratios and government support. What to avoid: overexposure to speculative, unprofitable tech. Stocks that are highly sensitive to tariff changes or dependent on Fed cuts to grow. So, let's recap. Markets are climbing, but on the back of strong AI tailwinds, not broad-based strength. The Fed may stay hawkish, and hidden risks are emerging in labor and trade. Smart investors are finding opportunity in tech, utilities, and emerging markets, but staying hedged with defensive plays. If this breakdown helped sharpen your investing lens, hit that like button, subscribe for weekly deep dives, and tap the bell so you never miss a market map again. And tell us in the comments, are you riding the AI wave or playing defense this month? This is Elite Growth Maps, where clarity meets capital. See you on the next one.